Hello, my name is Marty Frenkel. I am chair of Maddin Hauser's Financial Services Group. In all of our time working with mortgage clients, it has become clear that many within the industry do not truly understand how the note and mortgage function. Yes, we may be originating mortgages, we may be selling mortgages, we may be servicing mortgages, but no one ever actually talks about how these documents function within themselves from a legal perspective. As such, we decided we would prepare a series to discuss how these documents actually work. With me today is my partner, Corinne Rockoff. Talk to us a little bit about why are the note and mortgage separate documents that one signs at a closing?
So the note and the mortgage have to be separate because they really accomplish two separate things. They each attach to something different, and while they work in tandem, they're both part of the process, they have very different functions.
Okay, so, all right, so I understand that they have different functions. So walk us through the basic framework of a promissory note.
So the idea behind the note is that it really attaches to the person or the people who sign it. The note is about the individual person and the debt that they owe. So it's a contractual obligation on that person or those people to pay back money that was loaned to them. Now, in the context of a mortgage transaction, that's money usually loaned to purchase or refinance a home, but it's about the money more than the property.
So a promissory note, that debt, if I sign a promissory note and I'm in Arizona, it follows me. If I'm in Colorado, it follows me. If I'm in New York, it follows me. Is that accurate?
If you're in Timbuktu, it follows you. It's about your relationship to the money that was loaned to you.
Okay. So who are the parties to a promissory note?
So in the context of the note, we're talking about the lender and the borrower. The lender is the party that lends money. The borrower is the party that borrowed the money. It's a lot more literal than some of the other terms we'll run into in this conversation.
Okay. So then that's the basic concept of a promissory note. What is the basic function of a mortgage?
So if we think about the note, for contrast, as kind of a babysitter who's following the borrower, right? Just as you said, from Colorado, Timbuktu, wherever, it's the babysitter that follows the borrower to make sure they pay back the money that was loaned to them. In contrast to that, the mortgage is one that really babysits and follows the property. So the mortgage attaches to the property, and the parties to that are going to be the folks who own the property. That's where it really differs.
So again, if I grant a mortgage and sign a promissory note relating to a property in California, if I move, the note follows me to New York or Florida or wherever, but the mortgage stays on that property in California. It never moves. Is that right?
Exactly right. And whatever you do with that property or someone else does with that property in a lot of instances, if you leave it as empty farmland, you build a condo on it, whatever happens on that property, the mortgage is attached to that chunk of earth.
Okay. So who are the parties to a mortgage?
So oftentimes they may be the same people as the parties to a note, but we identify them differently. So first, the mortgagor, that's the person or the people who offer up an interest in the property. So that's who owns the property and are giving some portion of their rights in that property. Now, the mortgagee is the party to whom those property rights are given. So again, you'll see some overlap where the same person might fill roles in both the note and the mortgage, but it's not exactly the same function between the two.
Okay, so you said oftentimes the borrowers under a promissory note and the mortgagors under a mortgage are the same. Are there circumstances where they're not the same?
Absolutely. So the people who actually, person or people who actually take on the debt and have a personal obligation under the note might not be the same folks who actually have an ownership interest in the property and thus have to agree to give up some of that ownership. So probably the most common example that you see frequently is one in which, say, two spouses own a home with the property together, right? But for credit reasons, maybe whatever personal finance reasons folks have, only one of them is actually a borrower under the note and is personally obligated to pay back that money. while they both need to be mortgagors because they have a joint interest in that property that they can only give away through both of their agreement. So you've got two mortgagors and only one borrower in that type of situation. Happens all the time.
Well, thank you for explaining that, because sometimes the terms can be confusing when one is looking at a loan file. Why is someone signing one document and not another?
Especially when you call them such similar things. Mortgagor, mortgagee, it gets squishy real fast if you don't have it aligned.
Okay, so let's talk about the practical impact of the differentiation or split between a note and a mortgage and how that plays out. So for example, why does the mortgage have language that requires that the mortgagor keep the property in good condition?
Sure. So like I mentioned earlier, the mortgage kind of functions as the babysitter that attaches to the property, right? Its job is to keep an eye on the property and make sure that through whatever mechanisms, whether that ultimately ends up being foreclosure if things go south or just regular payment, the debt that's owed gets paid via the property, right? So as a good babysitter on that property, the mortgage has to make sure that that property stays in good enough condition that if things do go sideways, it can be successfully sold to recoup that debt. So if, for example, you've got a couple who, I'm going to call my sample couple today, Bob and Linda, right? Bob and Linda maybe are not great homeowners, right? Maybe they're not mowing the lawn, they're not keeping up with things. The house is starting to be in disrepair. If Bob and Linda quit paying their obligations under the note, remember that's where that money obligation lives, but if they quit meeting those obligations, the mortgage gives the right to sell the property to pay that debt, but maybe they've let the property go so far that it's not worth very much anymore. Maybe it used to be nice, today it isn't, and that can result in the mortgagee not being able to use those rights under the mortgage. So that's why you'll see those additional clauses that aren't directly about the debt, but they go in service of maintaining the health and value of the property so that it can be, all those clauses under the mortgage can be exercised and it can recoup the debt.
So, all right, so let's take that a step further then about a mortgagor not maintaining their property. Let's say Bob and Linda allow the roof to deteriorate and there's a storm and water flows through the house and damages the house.
Oh, Bob and Linda, yeah.
A foreclosure occurs, and after the foreclosure sale, there's just not enough money to repay the debt in full. What happens then?
Okay, so I'll give a very lawyerly disclaimer at the beginning. It depends, because this can vary from state to state exactly how this works. However, once the property is sold at foreclosure sale, that mortgage as a babysitter, it's discharged, the babysitter's off duty. However, that doesn't mean that the note is out of commission. So the note still is attached to the borrower, and whether that's both Bob and Linda or even just one of them, right? Say hypothetically, only Bob had good credit. Linda wasn't going to be as reliable with her payments. So only Bob is the borrower under the note. However, that mortgage being off duty doesn't necessarily discharge Bob's obligation to pay whatever is left. So if there's a deficiency and the property at foreclosure doesn't sell for as much as is required to pay off the debt, in some states, in some circumstances, the mortgagee and the lender at this point, because remember we're operating under the note, so it's the lender, can pursue Bob individually as a person based on the note's contractual obligation that balance be paid off. So foreclosure sale isn't necessarily the end of the road if there's a remaining obligation under the note.
So can the converse ever be true? Can we ever have a situation where perhaps the borrower's obligations under a note are wiped out, but the mortgage obligations continue on?
Absolutely. So there are all kinds of circumstances in which, for example, if there was a defect with the note, if something had gone awry in that situation, the mortgage still stands, right? The deficiency in one document doesn't necessarily undercut the other. Another, for example, if there's a personal obligation under a note and someone passes away during the term of that note, for example, obviously you can only be under contract because it's a contractual obligation with the person who signed. However, that attachment to the mortgage, to the land through the mortgage, gives a different type of security, and that's actually why we call it a security instrument.
What about a situation, would bankruptcy have any potential impact
Absolutely.
on the note?
Yes, absolutely. That's another situation where, similar to a defect in the note, but there can be a discharge of the personal obligation under the terms of the note in a bankruptcy proceeding. However, again, that note may have been made ineffective by that discharge, but the mortgage still stands alone. So that's, again, a great reason why we call it the security instrument, because it gives the lender that security that they're going to be repaid, and that's why the lender also wants to be the mortgagee. It's a two-pronged approach as opposed to just saying, hey, Bob and Linda, even though you're terrible at maintaining your home, you have bad credit, we trust you. We don't have to just trust Bob and Linda. We have the security that the mortgage provides, that as long as that house is still there, even if that house isn't in great shape, the ground is still there, that land is going to have value, and we can use that to pursue getting the debt repaid. Even if Bob and Linda aren't following through or have a discharge in bankruptcy, whatever happens, there's always that second avenue.
Well, thank you, Corinne. And thank you for attending our episode on the note and mortgage. Please look forward to our next episode as we continue to dig deeper. Thank you.